as markets look to bounce back from the losses of 2022. Our next guest is warning of a 10% correction for the S&P 500 on the horizon in the next 3 to 6 months. Chris Harvey, Wells Fargo head of equity strategy, joins us now. From your perspective, Chris, what would really trigger that move?
So there's a lot of macro risk on the horizon, right? We have the debt ceiling. We have student loan forgiveness, or what may not be forgiven. We also have the fundamentals. We are seeing multiple compression. We have the Fed that may be back in play. And we're also late in the cycle. And the last thing I would say is our price target is 4,200. That's 20 times on a 210 number. Those are both very healthy. We got up in and around those levels, and there's just not a lot of upside at this point in time.
So it sounds like if your price target is 4,200, and that's for year end, presumably?
Well, we got there, and then what we said is, okay, risk reward just doesn't look attractive.
Right.
We see these risks on the horizon. We think we're going to see 10% correction, and we feel that investors are a little bit too complacent at this point in time.
And with the Federal Reserve in particular, there was an interesting commentary out yesterday from the team over at JP Morgan that said, well, first of all, the market's assuming that the Fed is going to cut before year end.
Right.
But if they cut, it's because the economy is not doing well.
That's right.
If they don't cut,
right,
won't higher rates then be a headwind for tech stocks in particular, for example? So it's like, it's sort of a no-win. Is that how you're viewing it?
Yeah, what we say is hedge you lose, tails you lose. Because if the banking crisis tightens financial conditions, then that probably puts us into a recession. If that doesn't occur, then the Fed's back in play. And we don't know when the Fed's going to end. And what they've said is, hey, we want to keep rates higher for longer. And they're still talking about 2%. And as I listened to the commentary recently, they're not satisfied at this point in time. So financial conditions are going to get tighter, and that's just not a great environment for risk, especially when we're priced the way we are.
Is there a specific sector that you believe leads us lower as part of that correction?
It's not so much a specific sector, it's more of a style. What we don't like is we just don't like risk. We think risk is priced too expensively. We think companies with too much leverage, not the place to be. And what we want to do is we want to move over to more growthy, GARPy type names, things that are more stable, whether it's mid-cap growth. We also like sector-wise, we like media and entertainment. That's worked exceptionally well. Maybe we get a pause. Hopefully we'll get a pause here, pause that refreshes. And if you're looking more defensively, what we would say is the pharmaceutical space looks pretty attractive to us as well.
In general, are earnings bring you any solace in terms of your thesis?
Not really. So the earnings season is not as bad as feared. But if you look at banks, right, what did we get from the banking situation? We had a very dire, difficult situation coming in. We didn't have the worst fears come true, but the earnings potential for the banking space is somewhat limited. And what we're hearing time and time again is regulation, which isn't great for earnings. So the earnings season has been okay. The reaction, at least initially, was good because we've had a really big sell-off in financials. But as we get through it, it's much more idiosyncratic. It's much more stock specific. And at the end of the day, the economy's not going to bail you out and the Fed's not going to bail you out.
Is there a portfolio pivot that you would tell clients or strategize around, even ahead of the next Fed meeting?
I think our message to clients, and our message has been pretty clear, is you really want to de-risk the portfolio. Risk is not priced properly. You're not getting paid for risk. And risk is bounced pretty aggressively. And so if you have it on the table, take it off. If you have a lot of cyclicality, again, I think initially we were saying it's going to be an economic malaise. Now we're looking at a recession because some of the fallout from the banking situation. And so take that cyclicality off and look for more stable growers. Bring down the risk and look for just better risk awards and reduce your, just manage your expectations, because from here, there's not great opportunity to the upside.
What is risk in your view right now?
Yeah, so a lot of the speculative plays, a lot of the things that did really well back in 2021, and we did see many of these companies bounce earlier this year, and I think that was a gift.
Sounds like you're talking about tech.
So the answer is part of tech, but not all of tech. You have tech where there's still good valuations. Like again, if we look in media and entertainment, there's plenty of tech companies that provide that very attractive balance between good valuation and good growth. But tech companies that are priced for perfection or don't have earnings just yet and will do really well when rates come down and in 5 years maybe they'll have earnings, that's not the place you want to be, right?
Okay. Chris, good to see you. Thanks for coming in.
Good
Chris
to see you
Harvey,
too.
Wells Fargo head of equity strategy. Appreciate it.
Thank you.